welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The world of debt mutual funds can be a fairly confusing one. There are 16 different debt fund categories as outlined by market regulator SEBI. There is interest rate risk, which you need to be aware of. There's, of course, credit risk that could seriously damage your returns if it is not gauged properly. That's where a good debt fund manager comes in. Someone who can do all the thinking and the vetting for you, ensuring reasonably steady returns. Today, I get chatting with Ashish Shanker, who heads the private wealth division at Motilal Oswal, and we talk exactly about these issues. The aim, very simple, to help you pick the best debt fund managers which are out there and pick the best debt funds which are suitable to your risk appetite and, of course, to the market environment. Ashish, great to have you back on the show.
Always a pleasure to be on the show, Surabhi.
I remember this fund manager study that you did, and we discussed the equity study and the equity fund managers that you picked up. Now I believe you've put together a lot of research to pick out the best debt fund managers in the country. First things first, one would wonder that, debt is fixed income. So do fund managers really matter? What propelled the study?
So if you remember, we released the equity 4C framework sometime last year, and we were doing a study on debt as well. And let me tell you that debt was far more complicated than equities, because in debt there are two ways you can make money. I mean, one is through the interest that you accumulate, which is basically accrual. So if you put in 100 rupees in a 1-year fixed deposit, and let's say 10% is the interest rate on the fixed deposit, you end up collecting 110, and then minus taxes is what you retain. There is a second way to make money through debt, which is capital gains. So let's assume that you bought a bond which is giving you 8%, a 3-year bond at 8%, and after a year, for some reason the interest rates were to come down, the bond would not quote at 100, it would quote at, let's say, 102 or 103, because it will adjust for the lower interest rate, because the buyer will be willing to buy the bond at a lower yield. So it is a little more complicated, and till some time back the mutual funds also didn't have a clear classification, so it was quite confusing for investors. But with the new reclassification norms of SEBI, I think life has become a little simpler.
That's where we are, but simple is still not a word that's easily used with debt mutual funds, because there are two different philosophies. So let's start with the beginners class, really. Two very clear philosophies that you need to be aware of. There's accrual and there is duration. Basically what we're talking about is two types of risk. One would be the risk in terms of interest rates. If interest rates don't move as you expected them to. The other would be credit risk. Ultimately, it's a company that's issuing paper and you're lending this company money. What if the company doesn't pay back? What if there's a default? So just outline these philosophies for us and help us understand sort of clear differences between the two.
Right. To take the first point that you made, what happens is that when you invest, like I mentioned, the bond prices and interest rates are inversely proportional. So if interest rates move down, the bond prices move up to adjust for the lower yield in the economy, right? So if you were to buy a bond at 100 rupees and let's say 8% were to be the interest and the maturity was 3 years, after a year, if let's say the interest rates move down, then the bond would be quoting at a higher price, because the buyer who's coming into the bond will be willing to accept a lower yield for the next 2 years. So what happens is that when you invest in a bond, you also have to be cognizant of the interest rate risk, because if you have to exit before the maturity of that instrument, then depending on where interest rates move, you could either make a capital gain or a capital loss. So that's the first principle when it comes to fixed income. The second way you can make money is accrual. Accrual is very simple, which all of us understand. It's like a fixed deposit where you invest 100 rupees, let's say at a 9% interest for 3 years, and you stay invested for 3 years. So at the end of 3 years, you will make what is the interest rates on the fixed deposit. What will not matter to you is how interest rates have moved in between, because you're not exiting in between. So this is basically accruing interest on your bond, and it is called accrual way of making money. Now, within the accrual way of making money, you can enhance your yield by buying a paper which is, let's say, slightly lower in terms of the credit rating, but where you are confident that the company has the ability to repay you back. So today, if you, let's say, buy a AAA bond or put money in a AAA corporate deposit, the interest rates are closer to 8.5.
Yeah.
But let's say you like a company and you know that the company has a good ability to pay money back at the end of 3 years, then you may choose to invest in a company which is, let's say, lower rated, let's say AA, and you can make 9%.
Sure, sure. So are these largely close-ended investments that one would be making in accrual funds? What if you want to redeem before 3 years, I mean, in the middle of that period?
So what happens in mutual funds is that open-ended funds, typically there are three things that you need to watch out for. One is, what is the maturity of that fund, which is a collective maturity of all the instruments that the fund manager is holding. Now, there are two terminologies that an investor would ideally see on a fact sheet. One is the average maturity, and the second is something called a modified duration. Now, just to add a little more light to these two terms, the average maturity is pretty simple. It is the average of the final maturity of all the bonds or instruments that the fund manager is holding. But there is another term called modified duration. Now, what this indicates is what is the interest rate sensitivity of that portfolio. So the question that you asked, let's assume that the modified duration of a fund is, let's say, 3, and after a year the interest rates were to go up by 0.5%. Now, what happens is that the fund would have to mark to market, or it would take a temporary loss which is equal to the 0.5% interest rate rise into the modified duration, which is 1.5. Right? But generally, if you were to hold the fund for 3 years, the modified duration, you should be able to collect the yield to maturity in that portfolio. So what is important for you to note is what is the yield to maturity of the portfolio, what is the modified duration of the portfolio, and the average maturity of the portfolio. So these things are very important in a accrual fund.
So I mean, I think thumb rule, keep in mind, if you are going to exit before the average maturity, then you might be taking some kind of a mark to market hit, depending on this modified duration.
It could be a hit or a profit.
Or a profit, depending on which way the cycle is moving.
Absolutely.
Well, so those are some of the initial terms. It is a little academic in nature, but it's important to get those basic facts out of the way, because that will determine our judgment of which kind of debt fund to go in for. Now, we'll also look at fund managers, because that's what Ashish's study has thrown up. There are some people who are very good at judging accrual funds and looking at, of course, credit risk. There are some people who are very good at predicting the direction of interest rates. Who are these people? We find out on the other side. Welcome back. You're watching Money, 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 and this week we're in the midst of a very interesting conversation, picking the right debt funds and why it's important to know your debt fund manager as well, because it's different strokes for different folks. Some people are very good in managing interest rate risk. Some fund managers have an excellent handle on how to look at the best accrual strategy. So let's straight away get down to this. This is a really interesting bit, Ashish. So let's start with the fund managers that you have selected on the accrual side. Tell us the process and some of the factors on which you've rated these people and who's come out on top.
Yes, so let me just give you a quick rundown on the 4C framework, because that really is the foundation for picking the best managers in the industry. So within the 4C, the first C is basically the call on interest rate or credit, because as a fund manager, depending on the fund that you're managing, you should have the ability to either take a call on credit if it's an accrual fund, or a call on the interest rates if it's a duration fund. Second, what are the unique capabilities the fund manager has to be able to apply this philosophy to the fund? Third is the consistency of approach. I mean, has the fund manager consistently applied this philosophy and generated consistent returns for customers? And last but not the least is his experience or class, which is to say, you know, does he have a credit background if he's managing a credit fund, or does he have a background in macroeconomics if he's going to manage a duration product? Right. Now coming to accruals. Now, like I mentioned, accruals simply means that you invest money and then accrue the interest during the term of the product. So one, it is very important, like you mentioned in the earlier section, to match your time horizon with the appropriate product. So for example, if your time horizon is between, let's say, 1 to 3 years or 3 to 4 years, a short-term fund or a corporate bond fund would be probably the best product for you to start investing in. Or if you're clear that you don't need liquidity, there are fixed maturities plan also, which match your time horizon with the maturity in the underlying portfolios.
So now let's come to the managers. Who are the managers who came out on top in the accrual category and why?
So there are two things to keep in mind when you're investing in a credit fund. One is the fund manager's ability to assess credit, which is to appraise the company's financials and the ability to repay money. And second is, during the life of the credit, how will the company's future pan out? Because apart from the ability to repay, there is another event which affects the return in this fund, which is the upgrade downgrade event. Because a lot of times if we invest in the right company and it is single rated, it could so happen that the company does very well and the credit rating agencies upgrade the rating from single A to double A.
Right.
In that case, what happens is that the future investors are willing to take a lower interest rate on the bond, and your bond gives you a capital gain.
Right.
So even if the yield to maturity is 9%, sometimes fund can end up giving 10%. So while assessing managers who do credit, it is very important to understand their capabilities to assess the companies and look at how many upgrades they've got during the life cycle of their managing the product. So two people really stood out for us on the credit side. One is Santosh Kamath, and in his team there's another guy called Kunal from Templeton. They've been extremely consistent. I mean, I know they've had certain events where some of their papers have also got downgraded, but when we did the maths over the last 6 years, the upgrade to downgrade ratio is close to 1.5, which means for every 3 papers which got upgraded, 2 got downgraded, which is not so bad, because some papers which got downgraded may have given you a capital loss, but if you have stayed through their fund over a 3 to 5 year period, the upgrades were more than downgrades, so you ended up collecting a little more than what was the yield on the fund.
Okay, so I mean, they definitely then stand out. Anybody else managing credit risk very well in the accrual universe?
2 other AMCs which have managed credit very well. One of them is Birla Asset Management Company, Manish Dangi. He's done a great job in managing credit, and even Reliance Asset Management Company, Prashant Pimple and the CIO Amit Tripathi, they've also managed credit fairly well. And when we looked at their credit upgrade to downgrade ratio as well, it is closer to 1.25 to 1.3.
Okay, so those are some of the key managers as thrown up by Ashish's study. Let's move to the other facet of fixed income now. Now we're talking about duration funds. People who understand macros, who can take the right call on interest rates and then hopefully follow that cycle down. So, you know, if you're at the peak of the interest rate cycle and if interest rates are going to fall, then typically you should get a nice gain on your duration funds, right? That's how it works.
Absolutely.
Who are the people who can pick this right?
So like you mentioned, you know, credit funds are all about micros, but whereas duration funds are all about macros. You need to be able to understand what's happening in the macroeconomic backdrop of the country, which is inflation, interest rates, currencies, and then you should be able to call the interest rate cycle. The other thing which is important is the ability to read RBI's commentary at every policy. I mean, RBI policy is like a holy grail for the duration fund managers. So 2 people really stood out in this space. One is Suyash from Idfc Asset Management Company, and Amandeep from UTI. These 2 people, in spite of being in very challenging times over the last 6 years, have consistently delivered superior returns. So last 6 years, just to give you an idea, we've seen 5 interest rate cycles where the interest rates have either come down or gone up, and we are right now in a rising interest rate scenario.
It's been quite chaotic. I mean, just 6 years and so many ups and downs. You know, it's a very volatile, I think, graph when you're looking at the benchmark rate.
Absolutely. So to invest in a duration fund, you need to be able to call the interest rate cycle right. But having said that, what I've seen is some of the good guys like Suyash or Amandeep, in spite of having a choppy interest rate scenario, if you stay with them for 3 to 5 years, they've still managed to generate very, very consistent returns. So to give you an example, the IDFC Dynamic Bond Fund over the last 3 years, which has been a very challenging time for duration fund managers because the interest rates went down during demonetization and then have come up very sharply, he's still managed to deliver a return which is closer to 6.5 to 7%, which is a very good return in these times.
And I mean, obviously in debt funds, if you stay invested for more than 3 years, so the tax advantage being there, the returns will look much better than, let's say, a fixed deposit, which is offering you 6.5 or 7% right now. Okay, so on that note, we will take a very quick break. We come back on the other side and then get down to the brass tacks. Basically, what are the steps that you need to follow? What are the questions you need to ask yourself or your distributor or your advisor when it comes to picking the right debt fund for you? Back in just a moment. Welcome back. You're watching Money, 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 and this week we are talking about debt mutual funds, some of the most interesting managers out there who manage the interest rate risk and the credit risk very, very well. And of course, now we are down to talking the steps you need to follow when you are deciding upon a debt mutual fund. So let's just take it from the beginning, right. Ashish, once again. If I'm an investor, and I'll tell you, I think the profile of people who are looking at debt funds increasingly are those who want a slightly better return on their money than a usual fixed deposit. Right. That typically would mean that, you know, you're willing to be in it for at least a year, if not longer, 3 years if you really want the tax advantage. So how do you start? What is the first thing you need to map? How do you pick between duration and accrual? What's the starting point? Right.
So I think the first step is to try and understand what is your time horizon. I mean, how long do you want to invest the money for? Now, where really you have an advantage is the moment you have long-term money, which is let's say 3 year plus money, A, you can get a higher return, and second, you have a huge tax advantage over a bank deposit, because after 3 years these funds become long-term assets, and your capital gains comes down to effectively closer to 7-8%. Right, and you make superior returns. So there, now the first call you need to take with your advisor is to understand what kind of an interest rate scenario you're in. Now, if you're a first-time investor, keep it simple, buy accrual funds. Now, there are funds which have maturities of 3 to 5 years, and if you're coming into mutual funds for the first time, it's better to go with corporate bond funds.
And AAA rated.
AAA rated, which have 80% of the investments in AAA. Fortunately, today, even AAA bonds are yielding very good returns. I mean, today you can end up making post-expenses close to 8% even on a AAA portfolio. And you're actually locking in this at that 8% or 8.5% odd, which is what typically the AAA rated deposits or paper is offering. Absolutely. So the other thing which is important to also see in a fund is what is the net YTM, which is gross YTM is the yield on the portfolio. Then there are expenses in the fund. So the net YTM is what will eventually accrue to the investor. So it's very important to see the net YTM of the fund. Now after 3 years, if you matched your investment with a 3-year maturity fund, after 3 years you should largely get what is net YTM, plus minus maybe either a loss or a gain, depending on how interest rates are when you actually exit. But broadly, it should match the net YTM over 3 years. Since you raised expenses, and that's a very important point while investing, what is the average across the product category in debt? The average expenses that kind of... So again, depending on the kind of fund, like typically the liquid funds or the ultra short-term funds have low expense ratios. It can be as low as, let's say, 0.3% or 30 basis points. You get funds which have maturities of 3 to 5 years with expense ratios of between 0.5 to 0.75%. Okay, so you should just make sure that the expense ratio of your fund is within this particular range. It should be more or less around that level. Absolutely. Okay. Now, if you are able to take a little more risk, when I say risk, you know, let's say instead of all of the money being in AAA, if you don't mind, you know, some of the money being in AA or single A papers, and it's invested through the good fund managers that we spoke about, then you can enhance your yield by at least 1% further through a good AA, single A kind of a fund. There, of course, you also need to understand that there will be events during the life cycle of the fund which could be adverse. But if you stay through the time horizon, you know, eventually the fund manager should be able to deliver the net YTM plus maybe a little more if he gets his credit calls right. Try and gauge the mysterious world of macroeconomics. Okay, on that note, Ashish, as always, it's great to understand the theory. I think a lot of the concepts are now clear. Do tell us your favorite funds, across your favorite funds. It's accrual and duration. What are the kind of funds you're lacking at the moment? Yeah, so in the duration category, I really like the Idfc Dynamic Bond Fund and the UTI Dynamic Bond Fund. I mean, these funds have really seen different interest rate cycles and stood the test of time. So if you come into these funds with a 3 to 5 year horizon, I think you will make a return which is commensurate with the risk you are taking. And these funds don't take any credit risk. These are basically invested in government securities. So that risk is you know, out when you invest with them. On the credit side, really my top picks are the Templeton Short-Term Income Fund. This is again a fund which has stood the test of time. It's seen very, very trying times when it comes to credit, but has come through with flying colors. The other fund is the Birla Medium Term Fund. which also has a mix of credit and accrual portfolio. Again, a very good, very well managed fund. And the third fund that I like to highlight is the Reliance Credit Risk Fund. Again, they have a very good team in place, and their ability to assess credit is very strong. So Credit Risk Fund or the Reliance Corporate Bond Fund. One strategy which I'd like to highlight, since we are on fund recommendations, is today there are a lot of these funds who are running portfolios where they are buying 4 to 5 year papers, AAA specifically, because the yields are high, and they're running down these portfolios. So there the interest rate risk is also very low. So they're basically running it like a fixed maturity plan portfolio, but they're open-ended in nature. So they give you the flexibility to exit if you want to exit in between. But if you stay through the product, the interest rate risk is also minimized. Okay, so what is the category again that we should watch out for here? So Idfc has a fund in this category, the corporate bond fund, and Axis also has a PSU debt fund in this category, which is run on similar lines. Okay, well, fantastic. That's, I think, a lot of food for thought and some recommendations that people can start dabbling around with. You can do, of course, your own analysis, your homework and research. Ashish has given us plenty of, I think, starting points to go with. Thank you very much. Very interesting conversation, Ashish. Thanks a lot, Surabhi. Pleasure having you on the show. Well, with that, we come to the end of this week's conversation on Money, Money, Money. We'll see you again next week. Of course, your feedback, your questions, comments, queries, welcome as always.